2025 tax changes you can't afford to ignore.
Brian, I am so excited to talk about this because we know that there are two things that are certain: death and taxes. And in that same vein, one of the things we know about taxes is that they change and the rules change, and the things that we need to know about to positively impact our tax situation also change. And I'm excited that we can share some of those things.
Yeah, Bo, this is one of those annual traditions that I think about it. And this past year was a special year because we had the final transcript for Millionaire Mission needed to be updated with 2024 numbers. And I was like, come on, it's November. When are these numbers showing up? And then I think about also the special relationship as you get a year older, a year longer in your career. And if you want something that makes you seem old and senile, it's these annual changes.
Yep,
because
that's exactly right.
Every year I'm like, so the 401k max this year is what, 22,000? 22,000? And Bo's like, no, it's 23,000, soon to be 23,500. And I'm like, oh gosh, I still, So this is where we're going to catch you up. There will not be any mystery to what's coming your way in 2025.
That's exactly right. The IRS has now released these new inflation-adjusted contribution amounts. We're going to make sure you know them because a lot of us like to do our year-end planning at the end of the year. And one of the things that we do when we do our year-end planning is we set ourselves up to begin planning for the new year as we get into January. And there's some really unique additions specifically related to Secure Act 2.0 that we want you to know about because for a number of you, they might impact you. And if you can just take a little bit more and put a little bit more aside, oftentimes that can have a huge outcome for you. So let's jump right in, Brian. Let's talk about the first one, employer-sponsored retirement plans. So these are 401ks, 403bs, 457s, thrift savings plan. In 2024, the salary deferral limit, the amount that you could defer from your paycheck into these plans in 2024 was $23,000. In 2025, it is increasing by $500 to $23,500.
Well, look, as we come into December, this is something you probably need to go ahead and update, get with your HR so that as soon as we drop into the new year, this is part of your New Year's resolution pact. Let's update how much we can put in those salary deferrals. That way you don't have that surprise when you get your November or December paycheck of next year. You go, man, I didn't max out my 401k. I missed it. This is something that you need to update.
It's so frustrating when we look at like a client's W-2 and we see that they still had 22 or 22.5 as their deferral amount. Like, they just didn't update it. Well, in addition to the salary deferrals, if you're someone who is taking advantage of like mega backdoor Roth, or maybe you just have a very generous employer, the actual Section 415 limits are increasing as well. So when you add up all of the employee and all the employer contributions in 2024, the total amount that could go into a defined contribution plan for your benefit was $69,000. That next year is increasing to $70,000.
And then this next category, because I think they were worried about people my age. Do you feel like you're maybe having a senior moment? Well, they said, well, you know what? Let's keep those catch-up contributions for 50 and over the exact same. So there's $7,500 both in 2024 as well as for 2025.
Now, this is a unique thing, right? So catch-up contributions are staying the same, sorta. There is a little bit of an additional change. There are now what are called super catch-up contributions for individuals that are turning 60, 61, 62, or 63 next year. If you happen to be turning one of those ages in 2025, in addition to the $7,500 catch-up contribution you can also do a super catch-up of 50% of that amount. So you can do another $3,750. So if you are 59 now and you will be turning 60, or you will be turning 61, or you will be turning 62, or you will be turning 63 in 2025, you can actually do a catch-up contribution equal to $11,250. It's kind of confusing. I think it's awesome. I love people saving more money, but this one just seems like, right? I guess it's for people that are
I'll
behind.
be honest, even as you were going through that, it felt like you were reading Green Eggs and Ham by Dr. Seuss and Sam I Am. That super catch up is, that's something special.
That's something special.
I guess a legislator is like, hey, let's put this in there. And here we are.
Now, it is important to note that this is not a mandatory provision inside a 401k plan. So your plan may not adopt this change. So if you are someone who's 61 years old next year and you go to adjust this in your plan and it squashes it and doesn't let you, that might be because your plan has not adopted it. So when you get those annual updates, when you get those amendments, when you get your summary plan description, when you get the documents related to your 401k, make sure you read through them so that you understand what is available to you, what changes are happening inside of your plan.
Bo, you know what I like?
What do you like, Brian?
Besides people subscribing to our channel,
Ooh,
I love it when governments use a good acronym, because the government is not going to look past a great opportunity to put an acronym out there.
That's
and
exactly
we have
right.
one right now.
Yep. So long-term part-time employees, LTPT, long-term part-time employees are now, it's going to be easier for them to participate in employer-sponsored retirement plans. So this might be seasonal work, or this might be part-time employees who come on at a certain part of the year and then roll off a certain part of the year. These are the requirements in order for those employees to be eligible to participate in an employer-sponsored retirement plan. They have to complete 500 hours of service in 2 consecutive 12-month periods. So if you think about like a 40-hour work week, that's full-time for like 4 to 5 months out of the year, and they have to be age 21 by the end of the second 12-month period. So this is something, if you are a business owner, if you are a plan sponsor, you want to make sure you're paying attention to this, because you may have seasonal work or part-time work that's now eligible for a benefit that they were not previously eligible for.
Yeah, and pay attention, like internships and other things. This is going to impact a lot of different things, so don't sleep on this, because I think, we all want to make 401ks eligible people as fast as possible, but it is unique when you have seasonal employees and maybe they come their sophomore year of school, maybe they come their junior year of school, and you're like, whoa, wait a minute, this person is already eligible for the 401k even though they haven't started full-time employment.
Yep. So that is employer-sponsored retirement accounts. Now let's talk about some other savings vehicles that might be available to you, whether you're an employee or maybe even a self-employed individual. When it comes to IRAs, traditional IRAs and Roth IRAs, guess what? Contribution limits are not changing. In 2024, the total contribution for those under 50 was $7,000. That will be staying the same in 2025. And catch-up contributions for those age 50 and over also staying the same at $1,000 in 2025.
And Bo talked about with employer plans, the 415 limits. Well, SEP IRAs, which are only funded by the employer side of things, they did get a pickup. They were $69,000 in 2024. They're now $70,000 going into 2025.
And then when it comes to simple IRAs, which really we don't see a ton of simple IRAs anymore, but if you do work for an employer that has a simple IRA present, the salary deferral is increasing as well. In 2024, it was $16,000 salary deferral. It's going to $16,500. And similar to 401ks, the catch-up contributions are not changing. They will remain at $3,500, but there are also the super catch-up contributions for those individuals age 60 to 63 next year. So if you happen to fall into that category and your plan adopts it, there is $5,250 of catch-up contributions that you can do to a simple IRA.
By the way, if you work for a company that has a simple IRA, why?
Right.
I mean, seriously, most people have upgraded to 401ks. It's gotten so much cheaper to administer 401ks, so you can get higher, salary deferral limits. You get higher contribution limits as an employer. I'm just surprised that, and look, this is coming from a person that had a small business with a simple IRA because that was the progression. You went SEP IRA when you didn't have employees. You went simple IRA once you added employees. And then once you could afford it and had enough success and could afford the record keeping, you do a 401k. All that's kind of been changed with, innovation and technology, lowering the costs. And also, the legislation has made these numbers even better as well, where you can't really ignore because of the spread between the salary deferrals.
Well, and I think it's interesting with 401ks. I love seeing that we're able to save more money. Like that's an amazing benefit. We get to put more money to work. I was a little bummed to see that IRAs didn't increase because we love tax-free growth. It's why, Brian, do you have the thing can you hold up the thing? It's why we have the financial order of operations, and step number 5 are your tax-free savings vehicles. And in 2025, we did not get a boost on the Roth IRA, but you know what we did get a boost on? Health savings accounts contributions. For 2024, the maximum contribution you could do to an HSA was $4,150 for a single individual or $8,300 for a family. Those numbers in 2025 are increasing, and this is something you need to pay attention to, because a lot of folks have automatic salary deferral arrangements set up where this just comes out of your paycheck into your HSA every pay period. Well, if you were maxing out at the 4,150 or 8,300, you need to make sure that you increase it for January because the new limits are 4,300 for individuals and 8,550 for families.
Yeah, and then we can we even brought up going into education. We were like 529s and ABLE accounts. This is something we could talk about, and we did a little definitive research on this because we all know 529s are unique in the fact that you can kind of stack your contributions for years. You can add like 5 years into 1 year if you make that election, so you can really overfund these things. But the typical maximum in the past was for 2024 is 18,000. For 2025 it's 19,000, and that's because that's the annual gift exclusion. ABLE accounts, we were trying to figure out, do they have the same like stacking provision that 529s, because they're built on the same platform. We found through the Social Security Administration, no, they are limited by whatever the annual funding limit, gift limit is. So it is going from 18,000 to 19,000 in 2025.
I love it. It's amazing that while these may not seem like significant changes, just being able to increase how much you're saving into your 401k and just being able to increase how much you're saving into your HSA, if you were to add those two up every year, that's going to be about $650 more that you're able to get into tax-advantaged accounts. And while that may seem small and that may seem insignificant, if you can do that next year and the year after and the year after and the year after, time can be the most powerful part of your entire financial journey. If you don't believe us, we have a deliverable. You can go out to moneyguy.com/resources and download this deliverable. What can 1% more do, or what 1% more can do for you? And it shows the power of that small marginal saving. If I can start today and get my money working for me, it's going to allow my future self to have a great, big, beautiful tomorrow. And it does not take a lot today. It just takes time and discipline to put it into practice.
It is those small decisions that do create that great, big, beautiful tomorrow. It's that small incremental decision. You think about like even the koozie, the $1 for a 20, 21-year-old has the potential to become 88. We had somebody in the studio. Phil was in here not too long ago, and I loved how he kind of laid it out when we were showing him some things. He said, I thought about this in terms of time, and that's kind of what this is, that you can take this 1%, is that maybe 1 month worth of your work or even 1 week might be covering months, if not years, of your future selves' retirement. So that 1%, which might seem like absolutely nothing, a rounding error, can actually have significant impact in your future self. So don't sleep on that.
You can also find 2025 tax brackets, standard deductions, and more in our 2025 tax guide. So if you're not using this as a quick reference and a resource, make sure you do that. You can get it at moneyguide.com/resources. And if you want a deeper dive into some of these tax changes that are coming and how they may impact your back pocket, make sure you subscribe at moneyguide.com/beyondbasics. We have an article coming out this Thursday that's going to give you the details and let you dive into all of the changes that you can expect next year and how you can use them to ultimately do money better.
So you're probably recognizing, if you're brand new to the show, and we know that there are about 45% of you that are constantly coming in to the family here, is that we are a little nerdy. Yeah, we do a lot of the behavioral stuff. We'll focus on the good habits that you need to be focusing on, but we'll also give you the deets on what you need to be doing tax policy wise. And I got to tell you, 2025 is a big year because we just had an election. I know, look, we're all like, hey, the election's over, so now we can get on with our lives. Well, in 2025, there's going to be a lot of tax stuff going on because we have a lot of stuff that was set to sunset, and now we know that that's going to be on the front of the legislative agenda, is looking at tax policy. We will be your scoop. We'll be able to hook you up on that. And remember, we are very clear. We don't do politics. We don't do religion. We're just trying to help you make the best decisions, but we're going to keep you on the cutting edge of knowing what you need to do with your personal finances.
And we love that we can stay abreast of these changes, that we can know what's going on in the financial world, but we also love that we can speak to the things that you care about. We want to make sure we're a resource to help you in your financial life. And so with that, every Tuesday morning at 10 a.m., we love to be here answering your questions in the live chat. So right now we have the team out in the wings collecting your questions, and we want to load you up. So if you have a question, make sure you get it in the chat right now. With that, Creative Director Reby, I'm going to throw it over to you.
Oh, yeah, I've got one queued up. We're going to kick it off with a question from Jonathan V. He says, why does the goal of 20 to 25% invested for retirement not change based on traditional versus Roth accounts? Having $1 million in Roth could be very different from $1 million in traditional accounts. What do you think about this?
Yeah, so this is a great question, Jonathan. What the impetus of his question is, he understands the mathematics that if we make some tax rate assumptions, if I'm in a higher tax bracket now and I think I'll be lower later, or if I'm in a lower tax bracket now, higher later, Roth dollars and traditional dollars are not the same. If I have $1 that's going into Roth, it's actually after-tax money. If I have $1 that's going in traditional, it's pre-tax money. So I'm not actually saving the same nominal amount of money when I compare those two things. So what we tell people early on is that when it comes to building for your financial future, when it comes to figuring out how you're going to save, we want to make it as simple as possible so that you can master the behavior. That's why we shoot for 20 to 25%, because if you can do that, odds are you're going to set yourself up for future financial success. But then, as you begin moving along in your financial journey, we know that personal finance becomes incredibly personal. And what you will find out, what you will learn as you're moving along in your financial journey is you may recognize, because you've been maxing out Roth and you took advantage of HSA and you've built up all through your 20s and all through your 30s. And as you get into your 40s, you may do the Know Your Number course and arrive at the conclusion, man, I am well on my way to financial independence. I'm doing the things that I'm supposed to be doing. And because of my account structure, maybe I don't have to save 25% anymore. Maybe my savings rate for the rest of my career needs to be 16%, 17, 18%. That's a decision that you make as you begin to build out your financial plan later on in your financial journey, not one that you make right at the very beginning. Oh, if I'm going to do Roth, I'm going to save less. Or if I'm going to do pre-tax, I'm going to save less. If you start making those assessments too early, I think you're going to be selling yourself short.
Jonathan, I'll go ahead and give it to you straight. There are two things going on here. We got to get the actual behavior right, and the good habits, make them as easy as possible, and then keeping the bad behaviors minimized as much as possible. So I always focus on the behavioral side of things first, and then we're going to get into the execution or the fine-tuning later. And that's exactly what we've done with the financial order of operations. So many Americans, and this is something financial mutants struggle with, is that they get into the minutia of how do I execute this to maximize it, and they leave behind a lot of the behavioral and other things. So that's why if you'll notice in the financial order of operations, we got you covered because we are so nerdy. We focus on both of these things when we design this. Steps 1 through 3 all the way to 4 is to make sure you're getting the free money, making sure that you're not making desperate decisions because you didn't even have access to emergency reserves. We get to 5 and 6. These are the make wealth phase. You got to ensure that you're actually getting wealthy through saving and investing, creating your army of dollar bills. So that's why in steps 5, we got doing the Roth, the HSA, because those are tax-free growth opportunities. Step 6 with maxing out retirement. This is exactly what you're talking about, is 20 to 25%. If you go to moneyguy.com/resources, we'll show you why we landed on 20 to 25%, because if you started like the majority of Americans do in your 30s, it's going to land on about 25% from a behavioral standpoint of what you need to be saving and investing to be successful. If you start in your 20s, it's going to get that much easier. If you wait until your 40s, you're going to have to save even more. That leads to your question is, wait a minute, you guys, it is different when you're looking at a Roth account versus an after-tax account versus a tax-deferred account where you took the deduction on the front end. Well, you're exactly right, Jonathan. That's why in step 7, hyper-accumulation, after you've gotten to saving and investing 20 to 25%, you move on to the hyper-accumulation. And this is the first step where we say, hey, it's not just about making the wealth and the good behaviors and the habits that got you there. It's about how are you actually going to use this money in retirement. And this is exactly why if somebody is part of the FINE movement or aka previously known as fire movement, where you think you're moving on to something else in your 40s or 50s, you're going to need to structure your accounts different than somebody who says, I love my job, I love what I'm doing, I'm going to do this until I'm age 70. That is a completely different goal, and it's going to require a completely different account structure. So that's why we do make those determinations and those differentiations in step 7 of hyperaccumulation, where we'll say, yeah, without a doubt, you're going to need more of an after-tax bridge account. Or if you're one of these people, maybe your income structured in a unique way where you can do mega Roth, we're going to need even more in that tax-free account because of the benefits. And I think you can see, look, I just don't want you getting hyper-focused on just the tax savings, or that this dollar amount is not the same here because there's some deferred taxation within there. It's get you through the behavior components, and then we'll connect the math as we get into step 7. And that's why if you need to focus on all 9 steps of the financial order of operations.
Great.
Awesome. Jonathan V., thank you for your question. It is Tumblr Day. I just remembered. I almost forgot. But how could I forget? If you would like a Money Guy Tumbler, just email winner@moneyguy.com, and we'd love to send you one, Jonathan,
you
as
made
a thank
mistake
you.
There.
What?
It's not just a tumbler.
Oh.
It is also...
I'm so sorry.
Quack, 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 quack. A koozie.
It's true. It actually makes a great tumbler and a great koozie.
So
Can confirm.
don't sell this thing short. It has multiple skills.
Well, Jonathan V., you can have one if you would like. All right. Craig W.'s question.
Hang on. I think my nose is grown.
Do you just lied about something?
No, every time I take a drink,
I
nose,
like,
I've
is it not
never
a
noticed.
koozie?
I've never
it really
noticed.
does double as a koozie.
Now, every time I drink, listen, that has never been a problem before. So either this thing or my nose is grown. So we're going to have to, okay, I'm sorry. Joys of a live show.
There we go.
Okay.
That part was for free. You're welcome.
Let us know if you think
Sorry.
Brian's nose is different.
No, don't tell
Or
me
don't.
it's grown.
Actually,
I
don't.
did
Yeah,
not.
let's
That
not.
was not inviting comments on my nose length. Because we all know men's noses and ears do continue to grow. So I don't,
They
I
do?
don't need...
Is that true? I've
I
heard
think
that.
so.
Is that
I've
a
always
true-
heard that noses and ears grow.
Is that a legitimate thing, or is that like an old wives' tale?
I've never heard that.
I don't know. Is
We
that
all
true?
know I'm very deprecating about my age, but we don't need to add to it.
That's amazing.
Okay.
But it is clicking. Kind of annoying. We have to take this thing sideways.
That's exciting.
He is gonna spill drink all over himself. Guaranteed.
I look forward to it.
Craig W.
Yeah, Craig W. He has a question for you. He says, do you believe in paying off a $24K family debt at 0% interest as quickly as possible? We can pay what we want each month, but feel short-term struggle for a quicker way to freedom is the way. But what are your thoughts?
Do you believe in paying off a $24,000 family debt at 0% quickly? We want to pay each month, but feel short-term struggle for quicker freedom. So I got to make a bunch of assumptions here, right?
Sure.
I got to make assumptions that you borrowed some money from family. Maybe this is parents, maybe it's grandparents, and they were in a position where they said, "Hey, I'm going to give you 0%." One, I think that's incredible. Assuming this was something where like it was an opportunity. Hey, I need to go out and I'm going to go buy my first car, and I've got to borrow money, and I'm going to follow 23-8. And the auto dealership told me that my first auto loan is going to be 8.5%. And mom and dad or aunt and uncle or grandma, grandpa said, hey, you know what? We will loan you the money. We'll loan you $24,000. You pay us back, and we're going to do 0%. If you come from a situation like that, I am not of the opinion that you should feel guilty or feel bad or think that that's like a negative thing. I think it's wonderful that you just happen to have the opportunity where that's available to you. What you have to do is you have to recognize the benefit of the opportunity that you have, but also the responsibility of the social contract that you've entered into. Because, yeah, if you're thinking about mathematical optimization, okay, great. I've got this $24,000 loan. I'll just never pay it back. And it's 0% interest forever, and it'll just sit out there. I think that that would be taking advantage of an opportunity that's presented to you. So what I would love to see you do is I would love to see, because again, it depends on the type of debt, depends on your financial situation. I would want for you to find a reasonable method and mechanism to pay it off over a timeline that makes sense for you as well as the lender. So if it's like 3 years, 5 years, 10 years, I don't know, again, I don't know your situation or the specifics of this, because what I don't want to see you do is, because it is 0%, I don't know that I want to see you focusing on paying off this debt as quickly as possible to knock it out, instead of doing things like getting your employer matched, instead of doing things like putting money in a Roth IRA, instead of doing things like an HSA. But I also don't want to see you taking advantage of a generous family member simply because you can. There's some tension there in the middle that you'll have to figure out. Agree, disagree, want to fight.
Well, I remember when I was taking legal studies in accounting, I loved that I had to take I'm old, so quarters of legal studies as an accountant. And one of the first things, or one of the curious things I learned, was that in law, love is consideration when it comes to family members. And we know that our parents love us and they'll do anything for us. And sometimes that creates where there's unclear expectations or communication on what is expected. And I've shared, in Millionaire Mission, I share cash is such a valuable thing in the financial order of operations that if I could have had another hand, I'd hold up even more stuff. But it's that it actually gets 2 steps in the financial order of operations, both step 1 and 4. And I even detailed my knowledge comes a lot of times from also experience in the struggle. And I got in a point when I was first starting to do the adult thing that I really screwed up with credit cards and some other stuff. And I had to call my parents and they lent me some money. And then when I went to go pay them back, they're like, don't worry about it. And I remember, no, it was a principled thing for me, is because I was in a down and desperate, and I felt like I had not closed the loop on my change of becoming a different person with the way I viewed this, that I forced the issue of paying them back the few $100. Now, your situation's a little different, Craig, is that you're talking about $24,000.
Sounds significant.
But here's the thing where, and you need to go revise this if this was not set up on the front end, is that anytime you're doing these family engagements, I would first design a plan of success, meaning on the front end, what are the assumptions and the expectations from both parties? Meaning, did y'all have a 5-year plan? Did you have a 7-year plan? Did you have even a 10-year plan? Whenever you're doing this stuff for a loved one, tell them there's nothing wrong with helping out loved ones, but put it on the front end what your expectation is. Now, if your parents said, hey, we're going to do this, this is a tax strategy, because it's slightly beyond what the annual gift tax exclusion is, we're going to give you this money and then we'll slowly forgive it. That's a completely different thing. But it's, if you feel like that there was this desire, this was not a gift, this truly was a loan, you need to go back and maybe revisit that conversation with your parents or whatever family member worked this out. And then assuming you have the steps of or the assumption set up of what their anticipation is on when you should pay this back. If you now get to steps 8 and 9 of the financial order of operations, a 0% interest rate is a low interest rate. By all means, I think you pay this thing back even ahead of schedule of what they're anticipating getting that money back. But you've got to go through those several determination steps. Was this a gift or is this a loan? Because those are very distinct, different things. Also, set yourself up a plan of success. Know what they're anticipating and expecting. And then treat this like a step 8 or 9 type thing where you are going to prepay it. Pay it back because it's a low interest rate and that's your obligation. Can
I do like a little soapboxy thing?
Yeah.
This is unsolicited advice, but I'm going to give it to you anyways. Because I know you and I have both run into this where, there have been people in our lives at some point where they've been in a spot and they needed to borrow some money, right? And we were in a place where we were able to do that. And that's fine. First thing, if you're ever going to let someone borrow money, family member or otherwise, in my estimation, it's always a good idea to assume you're never going to get that money back. Like when you go into it, don't go into it with any preconceived notions, because what will happen is if something goes squirrely, it can get real nasty, especially when it's with family. But have you ever seen this happen? Somebody borrowed money and they're like, we're in a tight spot and they need to pay back. But then all of a sudden they just start making financial decisions and you're like, whoa, hold on. Wait. You were in a tight spot. Now things are better. And then you went and bought the new car, or then you went on the trip, or then you took the vacation. And you just want to be mindful of that. If this loan originated out of a place of need that you were in, and now you're no longer in that place of need, I do think it's reasonable to honor the folks that lent you the money. And don't just start like wilding out. Is that fair for me to say?
No, I think that is a very, because that's something, especially if this came from an ask of need, is because I have experienced that, where you help somebody out with the anticipation, this is not a gift, this is a loan. Because I get it. The economy stinks right now. I don't want you to lose that vehicle. I don't want you to put your family through this. I can help you out. And then it is amazing that, better days start coming. And I know, and this is, I think, the person who's struggling, you look at the person that gave you the money, like, they're doing good. They don't need the money. They don't need the money back. But it's back to the behavioral things. And I'm glad you brought that up, is because it's true. If you got this out of need and now you're starting to do some extras, that are publicly visible, you might need to revisit that, because I've experienced that. And then, one of the worst things, even though you're right, Bo, it is you probably don't want to do this with loved ones or family unless you're considering a gift, but it does break your heart when you see that even though they came to you in need and they treated it, they called it a loan and said, without a doubt, I'm going to pay you back. And then they basically ignore paying you back. You're disappointed.
Yep.
You're disappointed in it.
Good answer. Well, Craig, thank you for being here and for asking the question. And if you would like a Money Guy tumbler, we'd love to send you one just as a thank you for being here. And since we asked your question, just email winner@moneyguy.com to cash in on that.
Man, money and family's hard sometimes.
It's so
and
hard.
friends too.
It's
Just
hard.
that stuff's tough.
I do like what Bo said of like, hey, if you're the one that's giving the money, just even if they're going to pay you back, like mentally treat it as a gift. Like, I'm just trying to help this person out. It's probably for the best, just for everybody's relationship.
And I have to counsel people a lot. They're like, hey, I'm in a good spot. So-and-so needs help. I want to be able to help them out. And I will tell people, hey, you can do this, but you cannot afford it. Because whenever you loan money to family, I approach as, hey, assume you will never see this money again. And if all of a sudden that money was just stricken off of your ledger, would you still be okay? And if the answer is no, then maybe you're not in a position where you should be loaning that money out. Yeah,
I've even made that mistake here at the office. I mean, where I found out somebody had really bad credit card debt.
There's a number.
And then you help them out, and then I don't know. You have to be money's a hard.
Be careful.
It's a hard tool.
Yeah. Good conversation though. Again, thanks for your question, Craig. Robert's question is next in the queue. He says, I would love to hear the Money Guys talk about starting a business and what the boil point is to set up an official LLC, and give some similar advice, foo advice for business financials, etc. So is there anything about starting a business that changes the foo? And then what is that boiling point to when you're like setting up an LLC and really an official business? What do you think?
Well, let me give you the appropriate compliance disclaimer here. We can't offer any sort of legal advice, so we can't speak to you about when it makes sense or doesn't make sense to have some sort of entity formation, or even what type of entity you should establish. Because you mentioned setting up an LLC, but in some places, subchapter S corporation might make sense, or in some places it might make sense to just remain a sole proprietor. Here's what's really difficult about a question like this, Robert, is that every single business is kind of unique. And it's unique in terms of how it operates and the underpinnings of it and what's required and what the boiling point in that business is for that business to thrive. But there are some common threads. There are some commonalities across what we see to be successful business startups that turn into legitimate businesses, that turn into ongoing businesses. And I think we can probably speak to some of those commonalities. One of which is, whenever we see someone start a business, think about starting a business, in our opinion, cash is king. It is your friend in terms of making sure that you've saved up enough operating capital to allow you to be able to sustain the business. Meaning, if all of a sudden I think it was Jerry Maguire, and I mean, it's been so many years since in the movie, but like, he walked in and he just like had his epiphany and he quit on the spot and then went on his own, right? Like, Jerry, he did not quite plan the way that I would suggest you might want to plan for starting your own job. You might want to put some time to actually prepare what this is going to look like and begin to save up capital so that you have a cushion in case things don't go the exact way that you thought they would. Because you want to make sure not only do you have an appropriate emergency reserve to cover your standard living expenses over the course of 3 to 6 months, but you even have capital to carry you just in case the business itself takes longer to get off the ground than you thought it would.
Yeah, I mean, Bo, you make a great point. I mean, I've walked this journey, and I know I always think about the visual I have in my head is if you don't know how far the diamonds are in the ground. And what if you dug 9 feet into the ground and the diamonds were 10 feet in the ground, but you didn't have enough cash to where you could go that 1 extra foot? You did 90% of the work and yet you were at the success point, but you just didn't have enough resources or capital to make it there. And I think that's what gets a lot of businesses. So that's why I always say, put on your 3D glasses. That's the down to earth plan, what you think will really happen. Write that business plan out, get the spreadsheet out, and actually do the work. There's of course the dream plan. This is where you're like, well, how fancy of a car am I going to be driving after this thing is rocking and rolling? And then there's the do plan. This is like, if this thing goes bad, how am I going to recover and get my family back on track because I made this knuckleheaded decision? So without a doubt, do the 3D glasses plan. We talk about that with a lot of things. And then I wrote down a whole list here. The first thing I see people do when they're considering do this, make sure you set up boundaries and separate accounts. The government's going to expect it. So go set up and it doesn't have to be an entity account. You can just go set up a bank account that you're going to go do anything with this account other than business transactions. It can be the same thing. You go set up a separate credit card that is only for business transactions. At some point, we might turn this into where it's actually got the tax ID and all the other things that goes with the structure stuff. But go ahead and start creating the separation, because that's going to help you from an accounting standpoint. That's going to help you from a liability standpoint. It's going to help you from a structure standpoint. So make sure you go ahead and start living that separate life with these assets, because you don't want a bunch of commingling. I see so many small business owners that are running ragged businesses. They don't respect it. They don't treat it right, and it's setting them up for a lot of mistakes for the future. Maybe me coming from an accounting background, that's just a pet peeve of mine. Also, then you're going to get into minimizing liability, and this is where the structure stuff comes in. And that's why the threshold might be very low. If you're doing something that has risk, and that doesn't have to mean like necessarily you falling off a ladder. It might mean risk of you're doing transactions, you're giving advice, you're doing something that somebody could sue you for because there's high value to whatever you're giving advice or thoughts on. And that's where typically you start getting in the structure of like LLCs, S Corps. And I will tell you that Bo said it in a quick statement, but I'll tell you that states are different. I mean, we come from the state of Georgia originally, where everybody loves them some subchapter S. I mean, you typically go like single member LLC, and then once your business starts cranking, you turn into a subchapter S, and you pay yourself for what you're working in the business, but then you take the dividends or distributions out for being the owner of the business. So you do it in that legal structure. You move to Tennessee, and you realize they don't really like subchapter S's because they charge you a FA&E, which is a franchise tax, or what is it?
Franchise and excise tax.
Excise tax. That's the other part of it. So they charge you these things. So you don't see many subchapter S here. So you do need to do your research, figure out what is kind of accepted or reasonable in your state. You probably have to go talk to an attorney, and it's not that expensive because you want to definitely measure twice, cut once on getting your structure right. And then once you start having success, you might even need to go talk to that attorney or accountant again, because your structure might need to evolve with your additional success. And then I put on here accounting systems. You guys know when we did our collab with Caleb Hammer, I picked on him pretty hard. And a lot of you guys, what's wrong with using a spreadsheet? And maybe this is coming from an accounting background. I'm just telling you from rolling the business forward, because this is when you set up a business, it's perpetual, and you're going to have to file annual tax returns. You're going to have to reconcile bank statements. You're going to have to really, because let me go ahead and save you the heartache. When you start out, you're not going to be super busy from an accounting standpoint, and keeping up with it will seem very simple. But success, like everything I've talked about on the show, comes at you fast and creates a lot of complexity. So the better you can set yourself up while you're simple, the better you'll be able to grow and scale as you get complicated. And an accounting system is the backbone of all of that, because you're going to add in, you start off with just a checking account for your business, and then eventually you go add a credit card statement, and then eventually you're going to have employees that you're going to give them credit cards, and they're going to all come into one account, and it just starts getting to be a mess. And then you got loans, you got retirement accounts, you've got funding, you've got obligations. all that stuff, if you can set up an accounting system to start tracking that, even while it's a simple business, it gets much, much easier as it gets complex. And that's why I do like those type of systems, and they've gotten easier. I mean, I saw QuickBooks is even adding an artificial intelligence function, and I get nothing for sharing this. It's not like Intuit is a sponsor of the show at this point. But it is one of those things where, like, I love that I connect all of my accounts directly to my software, and I can be at home and in between a commercial break on a TV show and just sync up the accounts, go through the transactions. It can be that simple, but you just have to begin with the end in mind. So start simple, but go through these things and find somebody. You know, both Bo and I are part of you'd call mastermind or groups where we get around other business owners because it is kind of a unique thing, and it's in a journey that you go on when you start a company and you're trying to figure out how to navigate this stuff.
The only other thing that I was going to throw out here is when it comes to starting a small business, don't major in the minors. I've got a bunch of like knuckleheaded buddies, and they just come up with the ideas all the oh, this. And the first thing they immediately start doing is start working on logos and branding and thinking about the website and figuring. I'm like, guys, you don't have a business yet. Make sure that you actually have like a thing. Like, don't focus so much on the idea of having a business that you don't actually have something that another human being is going to be willing to pay for. Don't get lost spending all your time spinning up the website and thinking about the marketing and doing the brochure and doing all this stuff if you don't actually have the minimum viable product to prove that this business will actually work. I feel like so many people get lost in that. They end up spending a lot of money, spinning their wheels, and turns out this was nothing more than a quick little hobby that was a flash in the pan.
And then I'll add on, because I remember I was in one of my mastermind groups, and once a company starts doing well, meaning it cash flows consistently, I'm always amazed at how many entrepreneurs, because they've taken this risk and it starts working, they're trying to figure out how they go and do the next thing or real estate or whatever. And I'm always like, guys, you took a risk, a big risk, because a lot of small businesses come out in failure. As soon as one starts taking hold for you, don't skip actually doing the financial order of operations. I always tell people you've got to make wealth, and then to get to the where you can maintain or do all these crazy get-rich behaviors that you hear people doing where they're using leverage, real estate, and all these other things. I'm like, you need to get a foundation underneath you so you don't make crazy, desperate decisions because you hit a lick. And I saw a saying, don't assume you'll get rich twice. I mean, that is something that I want everybody who, if you hit a lick, don't assume you'll get rich twice, because I think a lot of people don't realize that lightning in a bottle. I get sentimental about memories that are lightning in a bottle. I get sentimental about business ideas that we've gone on journeys with that you're like, man, that was lightning in a bottle, and I can't believe that this all worked out.
Well, Robert, that was a good conversation. Good food for thought.
I didn't mean to go that long.
We like talking about small business.
Robert is probably grateful. Thank you for the question. If you would like a Money Guy tumbler, just email winner@moneyguy.com. Since we asked your question on the show, we would love to send you one. Thank you. Lo has a question next. It says, good morning. I was wondering if you have any advice on how to make RMDs with maximum tax savings. Also, how to reinvest them. Love the book. Thanks from an old timer.
So okay, for those of you that don't know, we get so excited about saving for retirement, and we have a lot of accounts where the government says, hey, if you save into this retirement account, we'll give you a break on your taxes. And so we max out our 401ks and we put money in IRAs, and we love seeing the tax deferred growth happen. And that's amazing until we get into our 70s. And then at some point, depending on your age, between age 73 and 75, the government says, okay, you've ridden this ride long enough. It's time for you to start taking money out of these accounts. And so you begin to get hit with required minimum distributions. The government says, hey, based on the value of your pre-tax accounts at the end of last year and applying an appropriate mortality factor related to how old you are this year, we're going to make sure you pull out a minimum amount out of your accounts in this following year. Well, what ends up happening is maybe you're someone who's living off of Social Security and you have a pension and you've done good saving. You're like, I don't need to pull money out of my 401k. I don't want to pull money out of my IRA. Well, you don't get a choice. And so what ends up happening is you kind of have this, I say tax bomb. You have this tax bomb that happens. All of a sudden your income shoots way high up and you lose some control over it. So the question Lo is asking is, hey, are there strategies that I can begin to employ, that I can begin to deploy that would help drive down the taxes of the RMDs? I'll speak to one. There's just a great opportunity that a lot of people don't know about. And then I think, Brian, it'd be interesting to talk too about maybe some preemptive planning you could do. But the one that I came up with, when it comes to RMDs, one of the great things that you can do, if you are someone who is charitably minded, we know that with the tax cut, the Trump tax cut, the Tax Cuts and Jobs Act from a few years ago, standard deduction increased. And so a lot of people aren't able to deduct charitable giving anymore because the standard deduction is so high. Well, if you're someone who is in the RMD phase, one of the things you can do is you can do a qualified charitable distribution where instead of you receiving your RMD, you can actually opt to give it directly to a charity of your choice. So if you have an RMD happening this year and it's going to be $20,000, but you want to choose for $5,000 of that to go to your church or go to a charity, go to an organization you support, you can give that money directly from your IRA to the charitable organization, and then on your tax return, you would only show $15,000 of income from your total RMD of 20. So it's an amazing way to remove income from your tax return and not get taxed on that. That's the one that I came up with.
Yeah, and the reason a lot of you are like, why would you do that if you don't go to tax deduction because the standard deduction is so high? Is because you guys, once you're retired, you'll quickly realize Social Security taxability does matter because maybe you're right on that threshold of where 50% or maybe none of it's taxable, and now you're trying to keep it from being 85% taxable, and that might even be changing with tax code that's coming in 2025. Also, IRMA Medicare premiums, your income does impact what your Medicare premiums are, so a lot of people will use the QCDs to help that. And there's even a weird quirky thing in the tax code right now is because a lot of RMD age is now 75, but QCDs can start at 70.
70 and a half, that's
so
right.
70 and a half. So, because that's the old RMD date. So there's a little arbitrage situation there. What Bo was, he added something there that I think is an important thing because there are a lot of people who are probably, maybe you're in you've left the earned income workforce, meaning you're not in your peak earning years anymore. So your earned income on your tax returns is going way down. Whereas when you were working, you were in the highest of tax brackets. But now that you've retired, you're in a much lower tax bracket. Don't sleep on Roth conversions because we find all the time is that like if you retire at 60, yeah, and RMDs don't kick in for you until you're 75. You've got 15 years to see if there's a tax arbitrage opportunity to where maybe now you're in this super low tax bracket. Should you be maximizing that 12% tax bracket, or maybe even should be maximizing the 22% tax bracket? You really need to go forecast how big are those RMDs. And for some of you, you have multiple seven figures in these retirement accounts. And once they fire up, you're going to be like, man, it's great. I'm paying no taxes. It's awesome. And then all of a sudden, whoa, I have a $200,000, $250,000 required distribution. That's going to be pretty taxable. So don't sleep on that 15 years. Make sure you're taking a proactive stance on looking at tax policy, looking at tax rates, and seeing if there's an arbitrage for you. But do be aware. This is where I tell you, complexity will find you. I tell you to do this, but then what you're going to do your tax. You're going to do this based upon tax rates only, and then you go do your taxes, and you're like, oh my gosh, I just screwed up my Social Security. Oh my gosh, I just screwed up my Medicare premiums. This is why I think as financial advisors, people love us, is because we help you herd the cats. We kind of think about all the things you don't realize. Even though I just gave you the list of a lot of things to think about, you still go realize there's a lot of wrangling that goes into making sure we're planning this well. And then you had asked, and I'll close out the loop on this. You said, how do I grow these distributions? It's not uncommon for when you're reinvesting that you just link your taxable account to these. You have to pay the man his portion for taxes, and don't forget to take into account where you live statewise matters. Some states don't tax retirement assets that heavily. They actually give you huge exemptions. Like I know Georgia. I was working on something for another state last week, and I was like, man, they don't tax Social Security or retirement contribution, or retirement distribution. So pay attention to your state taxes as well when you're thinking about the reinvesting, but then you just let it kind of grow up in that after-tax account and just try to be proactive. Don't let it just sit in cash actually think about it in conjunction with your whole plan to make sure you know what the why is for those new assets after you distribute them out.
That's great.
Awesome. Well, Lo, thank you for your question. Since we answered it on the show, we'd love to send you a Money Guy tumbler as a thank you. Just email winner@moneyguy.com. Joshin wrote in and asked, what are the rules for living off of stocks before retirement? I'll have a few years of no income because of grad school, but I have about $350K in a brokerage account. Do I sell slowly or all at once? And what do you think about this idea?
What are the rules about living off of stocks before retirement? Had a few years of no income because of grad school, but have $350 brokerage account. Do I sell slowly or all at once? Well, what are the rules about it? Well, we know this. If we've been saving into retirement accounts, if we've been saving into 401ks or Roth IRAs or accounts like that, we can't use them until a certain time. We can't actually get to those assets until 59 and a half. Or if it's a 401k, if we retire in the year we turn 55, we can do that. But these are like retirement assets. And so I think the question Joshin's asking is, okay, before I get there, before I get to 59 and a half, how should I think about creating an income stream? And if I have a portfolio, he said right now I've got $350,000, how do I think about that? And we have a lot of folks who do enter into early retirement and they're part of the FIRE movement or FINE movement. And there are some things that you can think about when it comes to early retirement. Like one of the ones I think about that I know we do for a lot of clients is, if you're able to manipulate your income to the extent that you can keep it super low, you might qualify for 0% capital gain. So even as you have these stocks and you begin to liquidate them as needed, you can pay 0% capital gains if you stay below certain income thresholds. What I think is interesting, though, for Joshin is if he didn't. Did he say his age?
No, but he said brokerage accounts. I'm assuming these are not retirement. These are after-tax assets.
One of the things that I would think through is if you're entering into retirement or if you're entering into pseudo-retirement, what I would argue is that before you even think about like, okay, well, how am I selling my stocks and how am I selling my brokerage assets is my cash, is my level of liquidity at the place that it ought to be at? Because, we say that when you're accumulating and you're in step 4 of the financial order of operations, you want to have 3 to 6 months of living expenses in liquid cash. However, when you get to retirement, when you get to financial independence, you start living off of these assets. We want to see your cash levels increase. We want you to have somewhere between 12 to 18 months of distributable living expenses available for you. Well, if you do that, what you're not going to do is get in a situation where you have to start immediately selling stocks or selling stocks at the worst possible time. So my immediate question for Joshua would be like, okay, what's the strategy or what are the rules for pulling out in early retirement? My question would be, what's the rest of your financial situation look like? Because that's going to dictate what the rebalancing strategy inside of the portfolio looks like.
Well, I think it's interesting because I'm going to take the stance that he's younger and he's on a sabbatical.
He just said I'm 28.
So younger on a sabbatical.
So this isn't retirement.
Well, but this is what makes it weird is like if you were a retiree, it's not hard for us to say, let's make sure you have 12 to 18 months of cash in your account and we'll replenish this every 12 to 18 months so that we can go to market and take advantage of, are we in a good time or a bad time, and take advantage of what's been performing the best and look at the tax rates and all the other things. And it's a nice, clean system. I worry about for somebody who's in their 20s is because if I had to guess, your asset allocation is going to be probably equity and then cash. That's it. Whereas your retiree is going to have equities, they're going to have bonds. So even if I liquidate, if we're done with cash for retirees, if the market's getting its teeth kicked in and I still need to get access to assets, I have a whole huge basket of fixed income and other very conservative assets. I can still go replenish the cash flow in retirement. Whereas you in your 20s, if you don't think about this sabbatical or period of time well, you might, if you only did, if you were pulling a just-in-time accounting system on your cash flow and selling every month, what are you going to do in those months or those intra-year volatility periods where the market's down 15% in a month?
Real fast.
You're going to be like, holy cow, how am I going to pay the bills on this? And you're going to get caught making a desperate decision. Fast forward, maybe you even said, I'll just go ahead and I'll liquidate for the next 12 months or even 18 months because I heard the guys talk about 12 to 18 months. That's what they do with the retirees. And then what happens? You get into 24 4 months and the market is down 30%, 40%, because your asset allocation is all equity, it's not going to be as well. So grad school, here's the thing. Begin with the end in mind. You know the time period. You know the goal, which is grad school. Make sure that I don't mind if you want to have a multiple tiered system here with it, but you probably need to go heavily more on the cash side of the thing of what the total value of the goal is, because you don't have a backup plan and you're definitely within that 3 to 5 year of what I consider short term. This isn't money you want to have at risk. So don't just assume you're like the same as a retiree, because your asset allocation and all the other things don't align the same way.
Yeah, I think I probably misunderstood the question. I was thinking pre-retirement, but this is how to fund something like an intermediate term goal. So if that's the question, Justin, here's a rule I think that I would think through. I want you to go to moneyguy.com/resources, and I want you to check out our wealth multiplier, because here's what I really want you to understand. If you're going to take a sabbatical, or if this is going to cover your grad school, you really need to understand the cost of every dollar that you take off the table, right? So if you have $350,000 in an after-tax brokerage account, that's wonderful. At 28 years old, you are well on your way for that money to turn into millions of dollars by the time that you get to retirement. But if you live off of that 350 and you pull it all out over the next 4 or 5 years, you need to recognize that what you did in that season was you pulled millions of dollars out of your future financial self. So you have to figure out, does that make the most sense? This is where I think, especially for people who are going to cash flow grad school or going to try to live off of their resources while they're still in the accumulation phase, being as lean as possible and having as small of a footprint as possible is probably the best solution. What you don't want to do is live high on the hog, get to the end of the sabbatical, get to 33, 34 years old, about to restart in your career and say, holy cow, I burnt through all the stuff I saved in my 20s. Now I'm behind. Right now, you are in the ahead position. I would try to do everything in my power to see, how do I stay in the ahead position.
By the way, in case this becomes a highlight, what was great about doing a live show is that we were getting additional details fed to us. So if that came off as like, why is this so segmented? It's because I give the content team, y'all were giving us, I guess, information's coming through the chat. Y'all were putting on the teleprompter.
I was just wandering around in the woods.
It's not even a teleprompter, but it's in front of the monitor, the comfort monitor.
The comfort monitor, that's what we call it.
That's a teleprompter too. No, it's just a screen so we see slides.
Yeah, that is a thing. Like if you're like live speaking, comfort monitor. But
by the way, yeah, when I was doing the book tour, I was like, can we just have a comfort monitor so I can see the slides and notes? And we didn't, so it was raw.
Now, remember the location?
It was like we didn't.
Was it
we
Texas?
kind of did.
Was it the Texas location?
Yeah, it was in the movie theater.
Could you imagine having a comfort monitor in there? No way. It wouldn't have worked.
Oh, yeah.
By the way, I can tell you, I love if you ask me my favorite venue, it's been far enough along that I can say this now. It was that Dallas show, which was in a movie theater. I kid you not. We're on they basically just go into a movie theater and flip on the lights and then just bring two nerds to stand in front of everybody. And I loved it because there were so many unique things that happened. Like we had a cockroach go across the floor that Carter kicked out of the way. We had one of you lovely people who was in the audience. You decided, with the full lights on, decided crocheting right in the second row.
Going to town.
Just going to town while I was talking, which was just kind of a unique thing to look up and see somebody just crocheting all the way through.
It was the only place where you could see the money, like you could see people and like make eye contact with them, and I think it made for a funnier show. But I think you loved it.
And how about the fact there's no green room? There was no green room or wait place for. So Bo and I were just hanging out in the entrance of another movie theater that we thought like there was no movie in there. There was no show going on, and then all of a sudden this older woman. I guess she was going to be the only person that watched this movie I'd never heard of. And she's like, what are y'all doing here?
Because we were both dressed up. She's like, I think we're going to the wrong movie.
Just so many funny things.
Honestly, that was a really fun show. Good energy.
It was a blast.
Really
I mean, we pretty much sold out this thing and it had everybody. And you guys, Dallas, I left that not only thinking the barbecue was really good, But I was like, maybe I could live in Dallas because I mean, you guys made us feel so welcome there.
Yeah,
it was awesome.
They like us in Dallas.
We got to figure out another reason to take this show on the road. That was fun.
And we got to meet Jake there too. You know, so it's
We
fun
did meet Jake, I know.
meeting.
Jake said Dallas was the best because I was there. He literally said that in the chat right now.
It's kind of true.
Well, maybe it was because Jake's wife was there.
There we go.
We got to meet her
See,
too.
we give the other. She gave all the beans. By the way, she just spilled it all.
All right, good sidebar there. But all that to say, Joshin, thank you for that question. If you would like a Money Guy tumbler, just email winner@moneyguy.com, and we would love to send you one since we answered your question on the show today. All right. Speaking of people we met on the tour, Carlos has a question. Hey, Carlos. I just wanted to know, how big should my emergency fund be if we are dual income and plan to rent out our house? Should we have separate emergency funds for each? And I like this question because he's respecting your real estate and cash rules, Brian and Bo. So maybe you can speak to it and give him a little bit of guidance.
Yeah, so let's talk about what should your baseline emergency fund be. If you're a dual income household, and let's say that you have about the same income, there's a lot of folks who say, hey, we want to be a little bit more aggressive. We feel comfortable with 3 months of living expenses for our emergency fund, and that's appropriate because we're both income earners and we're both at about the same spot. That would be permissible and allowable. But say you're dual income earners, but one of you has a much higher income than the other. Well, I would argue that there's more risk inherent in your situation. So your emergency fund should likely be greater than 3 months. It should probably be somewhere closer to 4 or 5, maybe even 6 months of living expenses. Well, that's just in the normal circumstance. That's just in the normal environment. Whenever you start introducing real estate and you start thinking about having a rental property or having other assets and obligations, I think that also affects the emergency funding, the appropriate emergency fund levels. Agreed?
Yes, and that's why I think when you get into this level of complexity, it's not, look, the input of what you're trying to create is only going to be as good as all the scenarios you plan for. And that's why I know we throw it out there all the time, but it really is when you get into doing rental property and renting out a house that you used to live in, you're kind of starting a new business. I mean, and there's a lot of things that even when you're thinking about taking on a brand new job, that's a new endeavor and it's going to change your cash flow. It's going to change your house dynamics. Don't sleep on doing the 3D glasses plan. I mean, there's a reason we talk about this is that I want you to do some preparation and do some homework and figure out, hey, what's going to happen if this goes really well? That's the dream plan. If it goes how I think it will, that's the down to earth plan. And then what happens when literally this thing goes belly up and it's the doo-doo plan? Don't sleep on that. And that's why you might come to because it'll let you do a gut check on your personality and how you handle the emotional stuff as well. Because if y'all are two separate people from an emotional way you look at money, and you see the doo-doo plan and you like full on panic, we got to make sure that we boost up our cash to get us through this point here. But then you're married to a cowboy that's like, or you know, you're in this relationship with somebody that's like, oh, it'll be all right. You know, it'll be, and y'all are in completely different places. You've got to go ahead and have that communication plan. And what if you're in two different places and y'all's income, exactly what Bo was talking about, are in two different places on who can provide what? You got to reconcile those things, and why not do it now before things go south, either with the property or with the dynamics of, you know, if y'all are having a tough time in the relationship, it's better to go ahead and plan this stuff now while things are good versus letting this be the thing that creates a lot of stress and strife in your relationship.
I do think, let me ask this, what are your thoughts on keeping those funds separate? Like, can you have all one emergency fund? Or if you have a rental property, should you think of that as a separate bucket of emergency fund?
Well, you have to be careful. Look, I don't want to, because there's a state, you know, there's who owns what. Relationships are tough, and I didn't hear Carlos talk about marriage or whatever, so that's its own other dynamic in there as well. But I'm trying to be respectful of the fact that if this is a couple living together but not married, is that these things are strange dynamics.
No, I'm talking about the household emergency fund versus if you have a rental property. Like, should that all be combined into one emergency fund, or should you have a separate
No, I
emergency
think you
fund?
could treat it as a separate, because
Right.
y'all are essentially have an entity together. But I do think what I thought you were alluding to, and I've had this conversation with somebody else recently, when you have two people making completely different incomes and they're living together and sharing a house, is that the money can become a power dynamic. And I always think that that's a weird thing, because relationships are already hard. So you just want to make sure that y'all have really good communication about the dynamics of money and emergency reserves and access and all the other stuff, because that's the hard parts that make the relationship, where it can get difficult, and if your communication's not good, it can fall apart. I don't know if that was clear, but that's what I've
Took lots of
experienced.
angles, but I mean, they were all good things to think about. Carlos, thank you for the question. If you don't already have one and want a Money Guy tumbler, just email winner@moneyguy.com. All right. Eric has a question up next. It says, my company offers you to buy into ownership. Shareholder bonuses usually are about 10 to 20% of the initial investment, and the value of the shares increase over time. What step of the FOO is this?
Okay, so the company offers you to buy into ownership. Shareholder bonuses usually about 10-20% of the initial investment. The value. Yeah, so this is just, I'm going to call this making partner. I have the making partner opportunity at my employer, because here's what you didn't say. You did not say this was some sort of like employee stock purchase plan where you're getting a discount on the shares. If you're getting a discount on the shares, I'd argue that's like free money. That would be more of a step 2 thing. If this is something where you're just able to buy into the entity for whom you work, and you're able to do it at a reasonable market valuation, in my opinion, this is going to be a step 7 hyperaccumulation, step 8 type goal, because you want to make sure you've done all the other things. Brian, can you hold up the thing real quick? You want to make sure that you've got the emergency fund in place and that you're building your financial foundation. You've maxed your Roth IRA. You've done your HSA. You're funding your retirement accounts. And this is no different than quote unquote starting a business, right? Like you would put this in the same place as starting a business, because basically what you're doing is you are in fact investing in a business. It just happens to be a business that you also work for. So not only are you saying, hey, my human capital is tied up in this thing and this is where my paycheck comes from, but now I also want to tie some of my financial capital to it. And while that could be a wonderful thing and could have an amazing ROI, you want to make sure you're doing it at the right stage of your financial journey, or not too early, or you become way over concentrated.
I've got a word for Eric: illiquid. You think about this. Bo laid out all the details, but even when we get to steps 5 and 6 of the financial order of operations, I mean, I don't want you. It would make me cry. I mean, physical wet tears coming down my cheek if you actually tried to get to your Roth IRA for an emergency. But you could do it. I mean, you really could do it. You could get even your 401k would probably allow you to either take a loan or hardship. You could get it. I would not advise it. It's not a good idea. But if you get in a pickle of a situation and you call your owner of the company and say, hey, that stock purchase plan I'm in, I've got a little hardship going on right now. I'd like to get some of that money back. They'll be like,
Nope.
no, it doesn't work like that.
Nope.
This is an illiquid investment. You have a period certain, or there's windows where you can take action, but only in those windows. So that's why Bo is spot on. Since this has limited access, it is illiquid. This is a step 8 of the financial order of operations. This is something after you've built the financial foundation underneath you, and you want to maximize the opportunities of what this could create for you, both from cash flow as well as from an investment in your employer. But I think Bo said something that I think is very valuable and should be emphasized. Be careful having both your human capital and your financial capital all loaded up in only one entity. Look, some of you can't help avoid it. Like, look, I've started several small businesses, and it's just the nature that sometimes that becomes one of your biggest financial assets. But I've tried in the background to be building up as much liquidity and access to assets elsewhere outside of my small businesses as fast as possible. Don't just assume just because things have been good this year and for the last 5 years, 10 years, that trees don't grow to heaven.
Mm-hmm.
Great. Well, Eric, I know. I was reading all the names that I had already done. But Eric, if you would like a tumbler, just email winner@moneyguy.com. We would love to send you one. Thank you for submitting your question. All right. Amber's question's up next for you. It's an open enrollment question, she says.
Yeah.
I know it's that time of year. When might an HSA or a high deductible plan not be a good idea? What should I consider? I currently have a low deductible plan, but pay a higher monthly premium. So how do you think about this as we go into this open enrollment season? Especially as a financial mutant with that HSA access potentially.
Yeah, so we love HSAs. We love what they can do for their triple tax advantage. You can put money in on the front end, get a tax deduction. You can invest the dollars. They can grow tax deferred, and then you can use them tax free for qualified medical expenses. They are wonderful. But they're not the end all be all. There are a lot of circumstances in which, and by the way, in order to be able to contribute to a HSA, you have to be covered under a high deductible plan. Well, the high deductible plan is not always the best decision. I'll speak to one scenario where it's not, and I'll leave some more for you. One scenario where it doesn't make sense is, let's say you work for an employer that has highly subsidized Cadillac insurance. You could go get the high deductible plan, and maybe it's going to be a lower premium, or maybe your employer covers 100% the cost. If they have another type of insurance that is fully subsidized or highly subsidized, and it's just co-pays, and it's not going to cost you a lot either for the premium or for the services that you might receive throughout the year, and you're a healthcare user that goes to the doctor and needs those services, you may be much better off taking the very, very affordable, really, really good Cadillac health insurance instead of opting for the high deductible plan just because you want to be able to contribute to an HSA. There's one example.
Yeah, look, you got to do the homework. Don't skip leg day. Meaning that open enrollment should not just be do what you did last year. It needs to be, you need to think ahead, begin with the end in mind, and say, hey, in the coming year, what am I going to be using healthcare for? Is it just catastrophic protection like a high deductible health plan will be providing because I feel healthy, things are good, no big life changes are coming my way? That's one option. But I'm the one, like a knucklehead that still does a lot of the HR and payroll stuff around here. And I love, one of my favorite things, because it's kind of like a gossip thing, this is what it feels like to work at TMZ, I think, is that when we do open enrollment, I get to see what people are choosing on their health insurance. I'm like, oh, somebody's doing some family planning because they went to that high premium. They went to that Cadillac plan. I'm like, I wonder why they're doing the Cadillac plan this year. And I know because we have a bunch of financial mutants that work here. They're doing it because they're growing the family more than likely. In the next 12 months, I'm going to have them come to my office and say, guess what? We're growing the family. And I'm like, yeah, I kind of knew it, because I saw your health insurance election. So there's nothing wrong. And look, that's the fun part of it. I'll tell you, I turned a certain age, and so did other people in my household, that I knew that there was like some testing that was required at these ages. It's expensive. It's pretty invasive. And they put you to sleep, and we go to a facility to do all this stuff. So
Tell us more.
Well, I'm just telling you, that this ain't cheap. All these, and they even got this racket set up to where you have to go talk to the doctor first. You're like, hey, you guys have told me we have to do this. Why do we have to have a consult beforehand to do this? It's because everything is to extract as much out of this process as possible. You might want the Cadillac insurance, like you have a lot of procedures or surgeries or things coming up. So there's nothing wrong with you being a proactive participant, doing the homework, thinking about how you're actually going to use this plan in the coming year, and do it. And then by the same token, though, if you did grow your family last year and now you got open enrollment coming your way, and hey, everybody's healthy, it looks like this is good, don't just stay on the Cadillac because that's what you did last year. Go to that high deductible plan, get back on the HSA savings, and don't skip out on just doing the homework. Bo, you always share, I'm going to screw this up, so that's all right because I got you to protect me.
Yep, I'm here.
You're supposed to look at what the premiums are on the high deductible versus the Cadillac.
Yep.
And then go look at how you're using the money. So because you got the savings, you got to go then compare where your deductible is on the two different plans, see where the difference is, figure out where the break even, and then make your decision.
Yep, that's the two of them. Then the next two are any employer incentives. If your employer puts money in your HSA, or if they offer any sort of health reimbursement account or something like that. And then fourth is tax savings. So you have premium costs, you have actual healthcare costs, employer incentives, then you have tax savings. You stack up those 4 columns or those 4 rows for all of your health plans, and every year in open enrollment, you make your decision which one makes the most sense for next year, and then next year, you rinse, repeat, and you make sure you're always optimizing. Hey, well done.
Well, I got
Good
half
tag
of them.
team.
You know, hey, 500 will get you in the Hall of Fame.
Amber, great question. Thanks for being here, and we would love to send you a Money Guy tumbler just as a thank you since we answered your question on the show. Email winner@moneyguy.com to cash in on that. Remember, just because the live stream ends doesn't mean that the personal finance conversation ends. Go to moneyguy.com where we have our entire archive of episodes on all kinds of topics, along with moneyguy.com/resources where you can get all of our free stuff. We've got some calculators, some free downloads that go even more in depth on some of the topics that we talked about today and more. So be sure to check that out because we made it for you.
Reby, what I loved is that last question. Let me highlight, it really did highlight the fact that money's only a tool. It's not really a goal. So, that's what I think we try to put out there to our Money Guy family is take an active role in your financial life. Actually realize those small little decisions you're making really can lead to your great, big, beautiful tomorrow. I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team, out.